Across Canada, real estate investors and landlords treat Bank of Canada rate announcements as the ultimate determining factor for the market. When a multifamily deal is being underwritten or a major portfolio renewal is approaching, owners sit in high-stakes tension, waiting for a rate drop of a few basis points to save their cash flow. A basis point is a unit of measure equal to 1/100th of 1%. But holding off on your fixed-rate strategy while waiting for the Bank of Canada to act is a miscalculation. The widespread market belief is that this institution directly sets the cost of all consumer debt in the country. In reality, the central bank's policy rate has a specific, limited reach. It only directly dictates variable mortgage rates. Variable rates represent just one segment of the commercial and residential financing market. Fixed mortgage rates operate on an entirely separate track. They are driven by a much faster, highly volatile financial engine that adjusts long before the central bank holds a press conference. Obsessing over the Bank of Canada leaves property owners blind to the real market forces pricing their long-term debt. To find the true benchmark for fixed mortgages, look at the banking supply chain. That benchmark is the 5-year Government of Canada bond yield. A bond yield is simply the return an investor earns for lending money to the government over a set period. When a bank funds a 5-year fixed mortgage, they do not simply lend out their own vault reserves. They must actively raise the capital to fund your loan. Financial institutions purchase this capital in the global bond market. The cost correlation is direct. If the 5-year bond yield rises, the bank's cost to acquire that capital rises in lockstep. This animated chart illustrates how your rate is built. The bottom block is the baseline bond yield. The top block stacked directly on it is the spread. This is a mandatory markup of 1 to 2% that banks add to their borrowing costs to ensure profitability. It exists specifically to cover the higher risk and operational costs of lending to an Ontario real estate investor, compared to funding government debt. Watch the baseline yield block. As it fluctuates up and down, the spread block remains rigid. The bond yield is the variable that dictates your final rate movement. A fixed-rate mortgage is essentially a repackaged government bond. The institutional borrowing costs are passed directly down the line to the landlord. Because capital is raised in the global bond market, we have to look at the geopolitical forces that dictate those yields and drive market anxiety. Consider a scenario where an overseas military conflict chokes off major global oil supply routes. Restricted oil instantly drives up energy costs, sparking fears of broad inflation. To protect their returns against that inflation, institutional bond traders immediately demand higher yields. As the Canada 5-year bond yield spikes to compensate for global risk, Canadian banks instantly raise their fixed mortgage rates to defend their margins. This chain of events makes domestic real estate a globally vulnerable asset class. Canadian landlords are directly paying for overseas geopolitical instability through their monthly fixed mortgage costs. This line graph compares reaction times. The flat, stepped line is the Bank of Canada, reacting slowly. The rapidly fluctuating line is the 5-year bond yield, pricing in real-time global data. For investors 120 to 150 days out, this yield is your ultimate leading indicator. You can use this to play defense. If the bond yield climbs steadily over several days, banks will follow. That is your signal to secure a rate hold immediately, locking in costs before the official hike. You can also use it offensively. If the yield trends downward, you can confidently anticipate a drop in fixed rates and optimize your exact financing window. In the current Ontario multifamily market, capitalization rates are compressed. A capitalization rate is the expected annual return generated by an investment property. A tight margin means a fraction of a percent in financing costs dictates whether a property cash flows or bleeds capital. Data awareness is useless without execution. Translating these leading indicators into a precise underwriting strategy is what ultimately protects your assets and drives portfolio returns. To discuss your investment goals, advanced underwriting strategies, and your next Ontario acquisition, contact Terry Riddick directly at 519-591-1725 or email Terry at terryriddick.ca.